In this video, we're going to change gears a little bit, and now we're going to talk about accounts receivable management. This is the second part of the cash conversion cycle. We want to talk about how can we get customers to pay us back quicker, right? So this is the time from the sale until the customer mails the payment, right? Now, the time from when the payment is mailed to when it's collected, that is another question altogether, right? So there are two questions here to manage this. How do we get them to mail the payment quicker? And then how do we get the payment to get to us quicker, right? So as quick as possible, we want to try to figure out how to do this. So we can look at this in three ways. We can look at credit selection and standards, right? How do we offer credit to people? 2, credit terms. What are the actual contractual terms for getting payment, right? And then finally, the last thing is credit monitoring, right? Trying to review the outcome of our credit policy and then ultimately making changes if necessary. So there are credit standards that every company must go by. And again, I also want to, I'm not sure it'll come up in a slide here in a sec or not, but if you have a business, these standards and how you apply them, how you should, I don't want to say should, I don't want to say must, but most good companies are going to have this process in writing. And the reason for that is if there is any deviation from your standards for a particular customer and that customer is unhappy, then you have opened yourself up for litigation, right? So let's think about these standards. There's what referred to as the 5 C's. Character, right? How has the customer been doing with meeting their past obligations? Capacity, what is their ability to pay? Capital, what is their debt relative to equity? Collateral, right? Do they have something that they could put up as collateral to help secure the credit? And then finally, conditions. What are the general economic conditions surrounding this current business environment? So those are the 5 characteristics that we want to review when you're thinking about offering credit to someone. Now, credit scoring is a technique used, and this is really for high volume kinds of things. And think about credit cards, right? I mean, they have thousands of people applying for credit cards every day. To do that all by hand individually would be very difficult. So credit scoring is where we apply some statistical measure to determine whether or not a person has the characteristics that we might want to offer credit to. So here we have an example, right? So we have, they're currently selling a product for $10. Last year they had 60,000 units. The variable cost per unit is $6. The firm's total fixed costs are $120, and they're contemplating relaxing their credit standards, right? So if they relax their standards, they expect to get a 5% increase in sales, 3,000 more units. There also will be an increase in the average collection period from 30 days to 45 days, and an increase in bad debt expenses from 1% of sales to 2%. Now, the company has an opportunity cost for accounts receivable investments, that is 15%. So we want to talk about how can we take this information and massage it, use a technique to figure out what this is going to cost us. Is it a benefit to do this or not? Now, fixed costs are sunk, so we don't have to worry about that, right? They're unaffected by the change in sales level. Now, again, we said sales are expected to go up by 5%. Now, the profit margin, right? The contribution margin is $4. So for every unit that we sell, we should have a profit contribution of $4 per unit. In this case, $12,000 is what we expect to happen as far as increased revenues. Now we have to think about the costs. So to find the cost, the first thing we have to understand a little bit about is the average investment in accounts receivable and the turnover of accounts receivable. So the average investment in accounts receivable, you take the total variable cost of sales and you divide that by the turnover of accounts receivable. And that is 365 days divided by days sales outstanding. So let's see how this works. So the total variable cost of annual sales under the present plan is $360,000, right? The variable cost $6 per unit times the number of units. And of course, at the new plan with 3,000 more units, the variable cost will go up to $378,000. Now, the turnover of accounts receivable, that's the number of times each year they actually turn into cash. We have to divide the average collection period into 365. Again, we expected that in this example to go from 30 to 45 days. So the turnover of accounts receivable is roughly now, instead of 12.16 times per year, it's 8.11 times per year. Now, put these together, right? So under the present plan, right, the average investments in accounts receivable, $29,589. Under the proposed plan, accounts receivable should increase to $46,603. So that is, again, the following, that's the average increase or change, if you will, in accounts receivable. So how does this work, relatively speaking, right? So the difference between the two proposals is $17,014. The required return on the investments, 15%. So 15% of $1,704. The cost of this marginal investment account receivable is $2,552. Now, this is considered a cost because it's the maximum amount that would have been earned on that $17,000 had it been placed in an equal risk kind of investment. What about bad debts? Well, under the current proposal, it's 2% times the $10 per unit times that's under the proposed plan. It'll be $12,600. Under the present plan, it's $6,000. So the cost of the marginal bad debt, the increase, should be $6,600. So what does that look like in a spreadsheet? We have a spreadsheet under working capital management where you can plug this data in. We see here's the $12,000 in revenue. So the net change in profits, $2,848. So this is a positive change in revenue, in profits. So the company should move forward with relaxing these credit standards. So again, there is a spreadsheet that you can plug these in, and it can be a little bit more complicated. We have another example in another video, but this allows you to understand, at least see a little bit about how this process goes as far as changing the variables in our credit granting process. Look forward to seeing you in the next video.